Hello and good day to you. This is Dr. Vicky here to present Chapter 6, the Merchandising Operations and the Multi-Step Income Statement. So in this chapter, we're going to learn about how to distinguish the difference between how service companies book their transactions with merchandising companies. So service companies are the ones that have no inventory. They are just selling their services. Perhaps like myself, an accountant, I might have a business on my own and I just provide my services. With a merchandising company, you're going to have a couple of things to be concerned with, and that first one is you need to buy inventory. If you are a retail company or merchandising company, you're going to need inventory in order to sell. So that would be the first thing, is that you have purchases. And then you sell the inventory. And then as you sell the inventory, depending on what kind of program you use, you will have to recognize the cost of goods sold. In other words, at the price that you bought the inventory, you are going to recognize an expense. And then in both cycles, of course, you collect cash or your customer pays it on credit, however the end result is when you're making that sale. So here are the balance sheets for two very well-known companies, Planet Fitness and Walmart. So on the balance sheet, you are going to have your usual cash and cash equivalents first, your accounts receivable next. Then the next step, as you see in red, are different. So with a service company, while they don't have any inventory, they're going to keep such things as supplies. For example, a hair salon, if all they do is cut and style hair, they don't sell any products or anything. The only thing they have are supplies that are used during their operations. For example, the shampoos, the conditioners, the hair color, things like that they don't sell, but they do have an inventory. And because supplies don't get used at the moment it's purchased, you put it on your balance sheet and you treat it like inventory, but it's called supplies because it's not sold and does not go out the door per se. So then the rest of your balance sheet is pretty much the same after that. On the merchandising company, you have what we talked about, inventory. So inventory represents the items that are sold for resale. For example, the salon that I work for, they not only have the supplies inventory, but they also have regular inventory because they do sell some hair products, some other kinds of things in their shop. So they have an inventory of goods for resale. So if it's just a service company, you're just going to have supplies. If it's just a merchandising company, you're just going to have inventory. On the other hand, you could have supplies as well because you have your cleaning supplies, things like that. When you buy things, especially in high volumes, and you're not using them right away, you need to report them as supplies until they are used. So going back to my example about being an accounting firm, we may not have the shampoos and conditioners that a salon has, but we do have supplies. For example, if you were to look on my desk, you would see that there's a whole bunch of stuff that I don't use every day. Paper clips, paper that I use for the printer, ink, stuff like that, your office supplies. If I had an office that was outside of my home and it was a standalone environment, I would have those cleaning supplies and other things that I would keep track of. Again, usually if they are purchased in larger volumes is when you have those kinds of supplies kept in inventory. So then your income statements look a little bit different as well. On the income statement for a service company, all you will see is the service revenue and then all of the expenses. And then on your income statement for the merchandising companies, you're going to have your sales revenue. That's the income that's brought in by the sale of merchandise. Then you're going to have your cost of goods sold. And when I mentioned inventory, I mentioned that we put the inventory on the balance sheet at cost. We do not put the amount on the balance sheet at the amount that we're going to sell it for. That's only on the income statement. So you've got two numbers when it comes to inventory. The one that you put on the amount that you place in your inventory on the balance sheet. When you reduce the expense in the cost of goods sold, is going to be the same as what you paid for it. So then you have your sales revenue, your cost of that inventory, and that brings you to your gross profit. So in this example, there were $129,400 worth of sales, meaning inventory cost plus profit. You subtract the cost of the goods sold, which is the same as what you did on the inventory. You're going to subtract $97,900 because that matches the sales of the merchandise. Let me say that another way. The inventory that is sold, let's say I've had 1,000 pieces of this, 1,000 vases in inventory. So I have sold 500 at $1 a piece. So our inventory is going to be $1,000 when we make the purchase. Then we've sold half of them in this reporting cycle. So we've sold 500. We are going to, and then we sold them at, let's say, $2 a piece. Okay. So we sell them at $2 a piece. So that means we have $1,000 in sales for 500 units. And then we have 500 at $1 a piece, which is the cost. So you're going to have $500 in, $1,000 in sales, okay, less your $500 in cost. So your net profit is $500. I said net, I apologize. Your gross profit is $500 because then once you determine what the gross profit is, there's my mouse, there it is. Your sales revenue less your cost of goods sold gives you your gross profit. And then after that comes all of your expenses. There's no particular reason why depreciation expense is listed here because that refers to assets. It's just saying that your expenses will come after the gross profit or after the service revenue. So now we're going to talk about periodic and perpetual inventory systems. This has to do with when inventory is counted for balance sheet purposes. So here, and this is particularly important to the merchandiser, not so much your service companies. Usually your service companies, their inventory is quite small compared to what they do on the service side. For example, the salon that I work with, they might have $30,000 in inventory, but the amount of sales that they do is quite higher than that $30,000. So particularly for those that sell a lot of merchandise, the type of reporting system that they use is very important. So there's three components. So we have our inventory, we talked about that. Then you have your sales revenue, we talked about that. That reduces your inventory. And then we have your cost of goods sold, which as inventory is sold, your inventory is reduced and your cost of goods sold goes up because it moves to the income statement. So the inventory, we said, is the total cost of acquiring goods that has not been sold yet. Your sales revenue is the total selling price of all the goods the merchandiser sold to its customers. And then the cost of goods sold is the cost at which the merchandiser purchased that inventory. Your sales revenue less your cost of goods sold, as we said before, is your gross profit. Your net profit comes later after you've deducted all of your expenses. So this is your gross profit. This is a simple picture of what the inventory system and its transactions look like. So you have your beginning inventory, then you have made purchases throughout the month. So your 4,800 plus your 10,200 in purchases means that for the month, you had a total of $15,000 in inventory available for sale. Now this $15,000 doesn't have to be for the whole month. Don't get confused with timing of these things. So if we're doing the records at the end of the month, perhaps we had a different shipment come in every week with our inventory. So this 15,000 could be 4 different invoices. That doesn't really matter when you're talking about the inventory system and the one that you use at this point. All we want to think about here is that your beginning inventory plus your purchases gives you your available goods for sale. So again, the 4,800, the 10,200 gives you your 15,000 total available for, let's say, a month. All right, so then we get to the end of the month. We count our inventory again. And so we end up with 6,000 in ending inventory. So you take the equation is your beginning inventory plus your purchases, which equals your 15,000. Then you're going to subtract 6,000, which is the cost of the sales that occurred in the same time period, to get your cost of goods sold. So 15,000 less the 6,000 for your ending inventory gives you what went out the door, which was $9,000. So on your financial statements, you'll see this ending inventory at 6,000, and on your income statement, under your cost of goods sold, you're going to see 9,000. And here it is in an equation. You have your beginning inventory plus your purchases less your ending inventory. So that's your 48 plus your 10,2 for 15. Your subtotal is 15,000, and then you subtract the ending inventory of 6,000, get you your cost of goods sold for 9,000. Or you could do that the other way around and just flip the cost of goods sold and your ending inventory. So your beginning inventory is 4,800, your purchases of 10,2, less your cost of goods sold. And this would be done if you were doing a systematic accounting system, because as your retail items are being rung up in an accounting system, it's automatically calculating the cost of goods sold. Because if entered properly, if the purchase invoices are entered properly, it's going to put a price per item that was on that invoice. So this purchase was 10,200. Let's say we had 102 items at $100 a piece, which gives us our 10,200. So our inventory, when we pull an inventory on hand report, again, this is just a report coming out of your accounting system. It's going to tell you that you have 102 items at $100 a piece. And then every time you sell one, your cost is going to be $100. Okay, so getting back to this equation, this usually is used when you're counting on your accounting system to be correct. And that concept will become important as we get to the end of the slides. So your beginning inventory plus your purchases less your cost of goods sold, which is what your computer tells you, equals your ending inventory value. This would not occur if you did an actual inventory count at the end of every month. A good business owner will do that, will take inventory periodically at the end of a certain period of time. It's not good to wait the whole year because then you have 365 days of time that you can't pinpoint where errors may have occurred, and it's going to cause a lot of digging and some analysis, and you might not get to why your inventory is off. Things like fraud, theft, those kinds of things can happen during the year, and if you only do inventory at the end of the year, you're kind of missing that window to find problems. So that's one of the things when we talk about controls, you want to have an inventory control system in place so that you can catch those things during the year. The best thing to do is to take time and count inventory monthly, especially with restaurants. They are, I worked for Denny's for 10 years, and they counted their inventory weekly because they wanted to be able to pinpoint where issues may be raised. And then they also want to make sure that they are accurately counting their food cost, because food cost is very a high risk in the restaurant business. If you're not maintaining your food cost to a level that you're making a profit, there could be a problem. So they did their inventory, counted actual jars of pickles, packages of potatoes, containers of buttermilk in the refrigerator, you name it, everything was counted for the order to be placed. And then they would receive their truck every week. All right. So with that said, just remember there's two different ways that you can do this equation. This one is based on the accounting system giving you the cost of goods sold, and this one is actually doing a count of the inventory. So what we just talked about is a periodic inventory system. It updates the inventory records for merchandise purchases, sales, and returns only at the end of an accounting period. Again, most times accounting periods are monthly. If you are in a corporation or some other medium, small company, and they talk about closing the books, they are closing the accounting system for the reporting period, which is usually on a monthly basis. So then to determine how much inventory is on hand and how much inventory has been sold, periodic systems require that inventory be physically counted by the employees at the end of that period. And as we talked about, they are counting the ending inventory, the actual ending inventory, in order to get the cost of goods sold. Now, there still may be adjustments to the accounting records, because if the cost of goods sold doesn't match what your accounting system has, then you need to do some research. But this is the equation when the inventory is actually counted. So the next kind of inventory system is perpetual. This kind of inventory system is usually used when the items that are inventoried are of great value. It may be like a museum or an art gallery. They have these large pieces. They're not going to want to wait till the end of the month to find out that they are missing a $10,000 painting, right? So they keep track of their inventory after every sale. After every time something is bought and sold or returned, the perpetual system is updated to actual numbers. And this says combined with barcodes, but everyone knows now that barcodes are used on everything. So we really can't say this about perpetual systems, because they're also used on periodic systems as well. So then we're going to talk about inventory control. On the periodic inventory system, Okay, sorry for that little interruption. Had to wait for the baby to stop crying. So we were talking about the periodic inventory system and the perpetual inventory system. There is an advantage to the perpetual system where the periodic sometimes can cause some issues. So in the periodic inventory system, the records are not up to date daily, as we talked about. I mentioned that some companies only do their inventory once a year. And you may have been in a Walmart or some grocery store or some other store that this is probably after the first of the year, maybe in February, where you walk around the store and you see these little cards everywhere saying they may have, say, counted or done or something, some note to the effect to let somebody else know that this item has been counted. All right, take number 3. Let's see if we can get through this now. So we were talking about the 2 different types of inventory systems, the periodic and the perpetual. Periodic meaning that inventory, a physical inventory of what is on hand, is taken at the end of various different periods depending on what management wants. A lot of times it could be annually, but annually, as we talked about, is a little more risky than doing it more often. Companies should really do it at least twice a year in order to, number one, help their records to be accurate, and number 2, to catch any kind of fraud or anything else that might be going on, any kind of stealing. So the periodic inventory system is very useful because many places have merchandise too much to count every day, so they rely on the accounting system to work as it should. When the invoices are booked, the inventory is recorded, and then when a sale is made, the inventory is reduced, and then at the end of the day, you have an ending inventory, and you hope that it matches what is actually on the shelves. The perpetual inventory system is done every time something is sold and every time something is purchased. The inventory is continuously tracked, and there's one big difference, another big difference, I should say, between these 2 systems, and that's estimating shrinkage. And shrinkage simply is another term for loss or possibly overage of inventory. Maybe something got rung up twice by accident. The customer paid for it, didn't realize it, and then their inventory is actually overstated by 1. But so shrinkage is the way to adjust the inventory to actual. So in a perpetual inventory system, when you are documenting inventory on the balance sheet as you go, then what possibly could be missing can be estimated. Whereas on a periodic system, if you don't actually count what is on the floor or on the shelves, you really can't estimate the shrinkage because there's nothing to compare it to. There's all you have is what the accounting system says. The only way you would know there's a problem is if your accounting system says you have 1,000 pieces of this article, yet you go out on the floor and you see 5, right? So those are the kinds of things where you have to say, oh, well, I'm missing some things here. So but you still really can't estimate it until you actually count the inventory. So that's the biggest difference. With the periodic system, where you are just checking, actually counting the inventory at different times during the year, you really can't estimate your losses or your overages. But on a perpetual system, it's easily to estimate because number one, the merchandise is not like thousands of articles. Usually this is a system, like I said, in an art gallery where they have a set number of items. They will know if something is missing. So now we're going to analyze some transactions as we do with every chapter. And we're going to be looking at how we account for the purchases of inventory as well as transportation cost. How do we handle refunds and returns? How do we make allowances? And how do we handle purchase discounts? And then you will be shown how to record the inventory related transactions in the inventory account. So for example, Walmart receives $10,500 worth of bikes purchased on account. So as we know from prior chapters that Walmart has, the exchange has been completed. Walmart is receiving the bikes and promises to pay the $10,500, so an account payable. So we have in our inventory, we've added $10,500 into our accounts payable, $10,500, and we record it as we've done in the past. So this is what is considered a purchase. So now $10,500 of bikes were sold to Walmart with terms FOB, shipping point, freight on board. What that means is the buyer, Walmart, must pay the transportation cost of $200 to the trucker. So what this is saying, that the freight on board that is being delivered is at the shipping point. In other words, where the products are being delivered to, they're the ones that have to pay the transportation cost. So here we have cash out of probably maybe petty cash of $200, and then we are adding it to our inventory of bikes for the $200. And again, inventory increases and the cash decreases. Somehow some of the bikes may have been damaged in the shipping, so Walmart returned some of the bikes to the supplier and received a $500 reduction in the balance owed. So those two accounts are going to impact the inventory as well as the account payable. So we're decreasing inventory and decreasing the account payable. Very similar to the transactions that we are familiar with. So purchase discounts are offered to a lot of companies, especially if they are a major buyer, with hopes that the cash flow on the supplier side will be much better. So a lot of times on an invoice, you'll see this sort of notation, 2/30, and then N/60. What this is saying is this first number. So for one thing, Walmart has 60 days to pay their payment in full. If they make their payment within 30 days, they get a 2% discount. So the discount period is that first 30 days. The net purchase after returns and allowances is due within 60 days. So again, the first number is your discount. This is the number of days that the purchaser has to pay in order to receive the discount. Otherwise, the whole invoice is due within 60 days. So merchandisers record revenue when they fulfill their performance obligations by transferring control of goods to a customer, either for cash or on credit. Again, remember that each transaction is two-sided, so there has to be a giving and a taking. So the control of the goods is now going to the customer, and then in exchange for the goods, The customer agrees to buy it on the credit or pay for it in cash right away, or a promise to pay. Helps to go in the right direction. So for a merchandiser who is shipping goods to a customer, the transfer of control occurs one of two possible times. So this FOB shipping point we touched on earlier with Walmart, the sale is recorded when the seller loads the goods onto the truck. So what this means is that the supplier, when the truck is at the supplier's place of business, for example with the bikes, when the bikes were put onto the truck, that's when they became Walmart, because the FOB is the freight on board shipping point is the one responsible for the transportation. FOB destination means that the sale is recorded when the goods arrive and are ready for unloading at the buyer's premises. So what this is saying is that the purchaser does not have control of the inventory until it arrives at their place of business, and they are not responsible for the transportation. The supplier is responsible for the transportation and is responsible for the inventory until it arrives at Walmart. So every merchandise sale has two components, each of which requires an entry in a perpetual inventory system. So here we are going to record the cash and the sales revenue, and then we're going to record the cost of the item that was sold and decrease the inventory. So these are the components in a perpetual inventory system. In the periodic system, even when just the accounting records are used, usually the inventory and cost of goods sold is not calculated until the end of the period, or until the end of the month or quarter that they are closing the books, so to speak. So the cash is the sales price, and the cost of goods are the two parts. So Walmart sells 4 mountain bikes at a selling price of $200 per bike for a total of $800 cash. The bikes had previously been recorded in Walmart's inventory at a cost of $175 per bike for a total cost of $700. So here we're recording the sale, we're increasing the cash and increasing the revenue, and then we're decreasing inventory and increasing the cost of goods sold. Don't let this confuse you, because you here on this first transaction, cash is the debit and revenue is the credit, and you're increasing both. And then with the inventory, your inventory is being reduced by $700, and that is your credit side. And then your debit side is the cost of goods sold, or your expense account. But remember, even though the expense is increasing, the stockholders' equity or net income is decreasing. So that's how you have the negative on one side and the negative on the other side, even though your expenses are increasing. So this is a situation where you have a revenue and expense account, and you just have to remember that the sales, things that increase stockholders' equity, is your credit side. Things that decrease your equity is your debit side. When goods are sold to a customer and they arrive in damaged condition or otherwise unsatisfactory, the customer can return them for a full refund or keep them and ask for a reduction in the selling price, called an allowance. So what that means is, let's say I bought a bike and I get it home, I think it's all okay. I was able to get it home, put the pieces together, and then find out, oh my, there's a great big gnash in the body of the bike. And so you take it back, maybe within a day or two, you let them know, hey, I don't mind keeping this bike, but can you take some of the price off? Can you reduce the price somewhat? Can you give me some of my money back? And that's what they call an allowance. So suppose that after Walmart sold the 4 mountain bikes, one bike is returned to Walmart in good condition. Walmart would refund the $200 selling price to the customer and take the bike back into inventory. Basically, the transaction is opposite. So they're giving the customer back $200 cash. They are going to reduce their revenue in a sales returns and allowance account. Okay, so that decreases the revenue, the $200. On the inventory side, since the bike is taken back into inventory, the $175 is added back to inventory, and then your cost of goods sold is also reversed. So here you have a credit of $175 because you are crediting the expense account. So what this is doing on the cost of goods sold is it's decreasing rather the cost of the goods sold and increasing the gross revenue. The month-end adjustment for expected additional returns is similar to that shown on the previous slide for actual returns with 2 differences. The refund has not yet been paid. It is only expected to be paid. To report this, the decrease in cash on the previous slide is replaced with an increase in a liability called refund liability. So what that's saying is that the customer returned the bike, but for whatever reason has not got his $200 back yet. But because the company has the bike in their hands again, they owe the customer the $200. So you still have a 2-sided transaction. You have the inventory, the bike back in inventory, and you have the funds that are owed to the customer. So your inventory is increasing and your liability is increasing, both increasing $200. Okay. The inventory has not been returned. It is only expected to be returned. To designate this, an account called inventory estimated returns is used rather than the inventory account on the previous slide. Earlier in the chapter, you saw that merchandise sometimes are offered purchase discounts from their suppliers to encourage prompt payment on the account. In the same way, merchandisers can entice their own customers to pay promptly for sales on account by offering a sales discount. So similar to the Walmart situation where they got a discount for paying for their bikes early, Walmart can offer a discount when they're selling something. Same notations apply. The first number is the discount. The second number is the number of days for which they have to pay in order to receive the discount. And then everything, but regardless, everything is due by within 60 days. And this means that the entire price has to be paid within 30 days, not just part of it. So here is a sales transaction. The selling price of 4 bikes we have as $800. The selling price of the return bike, the $200. So we're down to net sales of $600. The 4 bikes cost $700, less the bike that was returned. So that brings us to $525. So the gross profit after all of these transactions, $75. So let's look at something where we have two parts to a bundled item that a merchandiser might sell. What that means is, let's say we go to a radio shop and we're buying a radio for the car. What can come with it is a Sirius XM subscription, which is a radio package. Maybe if you haven't heard of Sirius, it's a package that people can buy and get radio in their automobiles via a satellite, so that you don't have to have a good connection. It's like the internet, and so the stations that are offered, there's a ton of them that are offered different kinds of music, different kinds of verbiage. Sometimes I think there might be news stations, but anyway, it's on a subscription basis. So with this radio that I want to buy, they're offering me a 12-month package. So if I buy them separately, the equipment and radio service sell for $100 and $150 respectively, meaning the radio itself is $100 and the subscription is $150. The performance obligation for the equipment sale is fulfilled at the point of delivery, meaning the sale cannot be recorded until the equipment is received by the purchaser, whereas the performance obligation for the radio service is fulfilled over the 12 months of service. So assume that the customer pays the $200 price, which is the bundled price. Notice it's $50 less than the packet if they were to buy them separately. So he pays for the radio and the service on October 30th. The customer receives the equipment on October 31st, and the subscription begins November 1st. SiriusXM held the equipment in its inventory at its $35 cost. So how do we book this kind of transaction? So first of all, you want to analyze the contract to understand what needs to be recorded when. So the customer pays the $200 price on October 30th, but doesn't receive the equipment until October 31st. And then the subscription begins on November 1st. So once you look at the terms of the contract, you looked at the rights and the obligations indicated, you identify the seller's performance obligation. So what does Sirius have to do to fulfill its obligation, which is to deliver the radio equipment as well as the service, the radio service. And we know the transaction price was $200. So now what we need to do in order to book the revenue and cost accurately is to allocate the transaction price to the performance obligations. So you take the combined price of $250 and you're figuring out what percentage of this $200 belongs to the radio, and then what percentage this belongs to on the service. So $100 divided by the $250 is 40%. So 40% of the $200 belongs to the radio. And then the other 60%, the $150 divided by $250 is 60%. So that's $120 of the $200 that pertains to the subscription service. And then you have your costs given at $35 for the radio and $10 per month for the service. So the next step is recognize the revenue when or as each performance obligation is satisfied. So the equipment sale, $80, is recognized when it gets delivered. The service for the $120 for the subscription is going to be booked at $10 per month. So here's what it looks like. So the cash is received on October 30th, but has not delivered the radio yet. So it accounts for the $200 as a deferred revenue. So initially we're going to record the cash because we got the cash, we have it, we're putting it in the bank, and then we're going to put it in a deferred revenue account, which means this is a liability. The company owes the customer the obligation of the radio and the service. So you have your standard transaction there, right? Then the next day, on October 31st, XM delivers the radio to the customer. So it's completing that part of the obligation. So now what we have to do is record the revenue for the radio as well as adjust the inventory. So the radio we calculated was $80 for the sales price, which was $80, which was a part of the $200. Remember, we allocated $80 to the radio and $120 to the service, to the Cirrus subscription. So now we are reducing the deferred revenue because the obligation has been satisfied and we're recognizing the revenue. So decreasing the deferred revenue, increasing the sales revenue. And then we're adjusting our inventory. We're taking the radio out of inventory. So we're taking it down $35. And then we are adjusting our cost of goods sold, which is an increase in expense. But remember again, it's decreasing stockholders' equity or net income because it is an expense. The inventory on this side is your credit side. The cost of goods sold on this side is your debit side of the transaction. So here you see it laid out. Deferred revenue is a credit. Is a debit because it's being decreased, and your sales revenue is the credit because it's being increased. Your cost of goods sold is your debit because it's increasing the expense and decreasing the inventory on the credit side. On November 30th, a month later, Sirius XM will adjust its account to indicate it has fulfilled 1/12 of its promised radio services, resulting in $10 of service revenue for the month. So deferred revenue for November and the next 11 months will go down $10 each month, and the company will recognize the service revenue, $10 each month. And notice, because this is a service, there is no cost of goods sold transaction. So now we come to the multi-step income statement. You notice here's Walmart again, showing you 3 different years. And so what they mean by a multi-step is that you're going to have your net sales, your total sales of everything. And then you're going to have your cost of goods sold, using the calculations we've used on previous slides to get our gross profit of the 125. And then you have all of your selling, general, and administrative expenses. And then you have your income from operations. So that is here in the middle. This is the income from your general, normal operations. Whatever it is that you normally sell, whether it's services. In this case, of course, it is materials, merchandise, retail, something that a company that is selling items and then having to recognize the cost of goods sold. So then other expenses, these are things that are outside of the normal business operations. Since these are expenses, these could be for example, taxes that could be in another period, or penalties because taxes didn't get paid on time. Things that are not generally in your operating income statement. And you can tell this similarly because if you look at the other lines, the numbers pretty much stay the same year over year. Hopefully you want your numbers to increase every year. But when you're looking at these numbers, they're quite different from one year to the next. So these are just things that are not usually occurring during regular operations. So at this point, get your EBIT, in other words, income before income tax expense. So this is the net income before tax. And then you are giving a percentage of tax. Remember, the percentage of tax has to be given to you in the problem. I can remember one problem using 20%. So you would take that percentage and multiply it on the tax expense by the tax percentage to get your income tax expense, and it brings you to the bottom line for your net income. So the steps here, first you calculate the gross profit. You have your income from operations. So one of the things that is used, as we've learned in the past, are ratios. And so we come here to another ratio that companies use, which is the gross profit ratio. And the gross profit is taking this line here, which is just sales less the cost of goods sold, and calculating the percentage. So you take your gross profit here of $120,061 and divide it by your net sales, which is the $481,317. So it's going back to the second slide before the calculation. So here we have the 125 gross profit, and it's dividing it by the 510,329 to get the 24.5%. 2018. So you see the gross profit margin is pretty similar from year to year. So when you're recording purchase and sales discounts under the perpetual system, remember perpetual means that the inventory is documented at each purchase and at each sale. So there's a couple of different ways. There's the gross method where you record the discount when the cash is received. Or there's the net method where you record the revenue less the discount. So the accounting department would want to know, okay, we are for sure going to pay this within 30 days. We're going to use the net method. Or we might not have the cash within 30 days. We're going to go with the gross method. So assume Walmart purchases merchandise at a cost of $1,000 with terms 2, 30, net 60, which means 2% discount if it's paid in full within 30 days. Otherwise, the full invoice is due within 60. Walmart's warehouse store, Sam's Club, then sells the merchandise to a local business at a price of $1,500 with the same terms offered to the customer. Walmart pays its supplier within the discount period, and the customer pays Walmart within the discount period. So using the gross method, the inventory is adjusted as if the discount had not occurred. So we're booking $1,000 in inventory and $1,000 in the accounts payable. When the payment is made in the discount period, so this was the first transaction. This is going to be the second transaction when the invoice was paid. So this $1,000 here is being reduced to $1,000. Because they are getting the 2% discount, the only cash they receive is $980, and then the inventory is going to be reduced $20. Because this is a discount on a purchase. Got to remember what kind of transaction the discount is being offered on. So it's the first one where Walmart is purchasing the merchandise. This is their purchase inventory invoice that's being booked here. They've received the inventory. They haven't paid it yet. They have 30 days in order to recognize the discount. So they've decided they can pay it within the 30 days. So they're reducing the account payable originally booked. They are paying $980 to the supplier, and then they are reducing their inventory by $20. All right. So now assume Walmart purchases merchandise at $1,000, same terms, same thing, same transaction. This time, though, we're looking at the selling of the merchandise. So when the goods are delivered, the sales revenue is recognized, and we haven't paid it yet, so they're putting it on accounts receivable, which is this local business at a price, merchandise sold to a local business at $1,500. Then they are recording the cost of goods sold at the $980, which is what we calculated before. And then when payment is received in the discount period, we again have three parts to this transaction. The customer is paying the cash of $14.70. They are taking advantage of the sale discount of $30. And then the accounts receivable, the whole thing is reduced by the $1,500. Sales discounts is actually an account that goes on the income statement that reduces sales. So when we're talking about net sales, that's going to be your sales at full price less any sales discounts. Because generally the sales discounts do not get recorded until the invoice is paid. All right, we have the same transaction again, only this time we're using the net method. Remember before, we weren't recognizing the 2% until the transactions occurred. Let's run over that just one more time. So we have our original transaction. There's no discount being recognized at this time on the sale. Okay? It's not recognized until the cash is received. Same with the purchase. The discount is not recognized at the time the inventory is received. It's not recognized until the invoice is paid. Right, so this is the gross method. So now we're going to move on to the net method using the same transaction. So on the purchase, we are automatically going to assume that we are paying this within 30 days. So we are going to adjust our inventory by the $980. We're going to increase our inventory, and our account payable is going to be for the $980. And then they're going to be sure and pay it within the 30 days. So now their accounts payable is decreased and their cash is decreased. So nowhere you really don't see the $20 discount. It's just simply recorded as is. Same thing on the sales side. You have the same terms, the 2% discount, but this time they are recognizing the discount right off the bat. So sales revenue of $14.70, accounts receivable of $14.70, and then your cost of goods sold. And then your cash is increased and your receivable is decreased when it's paid. Again, there's nothing in this transaction that refers to a discount other than we know the terms of the offer. On to another topic. I know this chapter's been kind of choppy. There's a lot of different concepts within the chapter. There's also a lot of back and forth, a lot of jumping. So hopefully this will be understandable to you. Take a look at the book again, but I'm always open for questions. Please let me know. Send me a text. This weekend I was out of town, so that's why my texts back were a little bit delayed, or my emails were a little bit delayed. But as most of you know who've gotten in touch with me, I'm usually very responsive with the text messaging and the email. So here, this next topic, recording inventory in a periodic system. So going back a few slides, the periodic system again is when the inventory is actually counted at certain periods of time. It is not counted after each sale or each purchase, which is the perpetual inventory system. So in the periodic system, let's say an electronics retailer stocks and sells just one item and the following events occur. The beginning inventory is 80 units at a cost of 60. On April 14th, they purchased 170 units at a cost of $60 each. In November, they sold 150 units at a unit sales price of $80. And then they counted at December 31st, 100 units at a cost of $60 each. So we're going to record these events, assuming the company uses a periodic inventory system, and then compare that to the perpetual. So in the periodic, when the first purchase is made in April, purchases or inventory is increased, the 10,200, and the accounts payable is increased as well. On the perpetual inventory system, inventory is adjusted right off the bat, and the accounts payable part is the same. So on a periodic system, remember, we don't do the cost of goods sold until the reporting period. So when the company sells 150 in November, all they're going to record is the sale. Their accounts receivable increases $12,000. Their sales revenue increases $12,000, and there's no cost of goods sold entry yet. That's the important word, is yet. On the perpetual system, inventory is adjusted every time something is sold and every time something is purchased. So here, the inventory account is increased and accounts payable increased. And then when the sale occurs in November, the account receivable is decreased. I'm sorry, the account receivable is increased as the sales revenue is increased. And then the second part of that transaction is recording the cost of goods that were sold. So 150 units at 60 is your 9,000. So Again, in the periodic system, now we're at the end of the period. So now we're going to count the number of units on hand, physically count them, compute the dollar valuation of the ending inventory, and then compute and record the cost of goods sold. So here we have the beginning inventory plus the purchases of 10,200. And then we're going to minus the ending inventory to give us the cost of goods sold. So this ending inventory is what we've actually counted. So at December 31st, we're going to book the cost of goods sold, increasing our expenses there. We're going to increase our ending inventory by 6,000, technically reversing the 6,000 and the 4,800. So we're taking out the original 6,000, adding back the 4,800, and then adding our purchases. And then because we do account for inventory and cost of goods sold as we go on a perpetual system, there are no entries involved at the end of the year. You will see, though, that despite which way is done, the impacts are the same. The only difference that might come out in, let's say, two different companies, one periodic, one perpetual, is that on a periodic basis, theft and things like that can occur more easily. And then on your perpetual, because things are being tracked as each sale is made, as each purchase is made, it's more likely that they are able to catch things more quickly, and they will be able to estimate their losses if there are any. Whereas on the periodic, there's no way to know. We just have to trust the accounting system to let us know. So that brings us to the end of Chapter 6. I just, again, want to reiterate, if you need help with anything, please let me know. I'm available evenings, most evenings, and usually on the weekends. I have helped several people, and they have been able to either catch up or get a better grasp of what's going on. But most everyone in the class is doing well, so I encourage you, if you need help, please reach out. I'll be glad to help. All right, see you next time.